Hey everyone, welcome back to the channel, your number one source for income-oriented investing. Got a special guest with me today here, Dave Mazza, Chief Strategy Officer at Roundhill. How's it going, Dave?
It's going great. Thanks for having me.
Yeah, thanks so much for taking the time. As you know, my channel is all about income investing, and when there are interesting covered call style ETFs that come out on the US market, I always try to get in touch with the fund manager to do a Q&A and get the information straight from the source. So I have to admit, you guys responded in less than 24 hours, which is fantastic. So thank you so much for that. Sometimes I do get ignored more with the big guys, but that you know how it goes. I've been getting a lot of questions and seeing a lot of interest in the two. We're going to focus on the XDTE and QDTE ETFs today, of course. These are making a lot of commotion in the income world because they do use covered call strategy, but they use daily covered call strategy. Defiance came out with theirs, but you guys actually came out with, actual covered call ones, very similar. So QDTE is the NASDAQ 100 index one, and then there's XDTE, which is the S&P 500. And what really stands out to me right away is that you guys are actually doing weekly distributions. That's right, guys, weekly dividends. And I believe you already came out with two of them. And I'm just going to share my screen real quick in case my audience doesn't know what we're talking about. These are the ETFs we're going to be talking about here. QDTE. Remember, guys, if you're Canadian, you're watching, these are listed on the US stock market. So this is the NASDAQ 100 zero DTE covered call strategy ETF. And then you have the same strategy, but on the S&P 500, which is the XDTE ETF. So first time on the channel, Dave, really appreciate it. Tell me a little bit about Roundhill, because this is a lesser known, or it's a smaller ETF provider. What can you tell me about your firm?
Yeah, no, happy to do so. So Roundhill Investments was founded in 2018 by Will Hershey and Tim Maloney. And the idea in 2018 was to really create ETFs that were focused on innovation in different ways. And that historically meant really innovative thematic equities. The firm became best known for launching the first sports betting ETF, BETS, also the first metaverse ETF, which remains the largest and most liquid. The ticker is METV. And then more recently, we have been moving into areas where we apply innovation into either the outcome or the structuring. And so in this example, when we're talking about XDT and QDT, it really is on the structured side. So you hit a few things that we're excited about and proud to bring to bear here, not just using the daily covered call strategy, but then pairing it with the weekly distributions that we have with XDT and QDTE.
Okay, perfect. Yeah. So give me a little bit the premise behind QDTE and XDT. You kind of started touching about it. Tell me what the objective of these ETFs are. What's, for which investor did you have in mind, and really how they work. So tell me all about these two ETFs.
Yeah, so if I go back and forth between QDT and XDTE, the reason I'm doing so is that they're essentially and principally the same, just using a different underlying reference index. So again, as you noted, QDTE is focused on the NASDAQ 100, XDTE is on the S&P 500. And the idea behind these strategies is that, and really the main investor base that we would expect to be interested in them is those seeking income, particularly high income potential, because strategies of this nature are going to generate, by just simply put, a higher income than many other potential solutions. But the benefit here is two things. One, so we're going to have that high income potential paid on a weekly basis. Then you do have upside exposure, beta exposure to the market, because we actually have overnight exposure, because the covered call strategy is implemented daily. So every trading day, somewhere imagine between 9:30 and 9:45, the portfolio managers of these funds are out in market selling those calls to generate that premium. But then we have a long exposure that folks will have exposure to, so that you have a beta into the market. The reason why that we think that can be important over the long run is it has, one, again, combining the potential for high income, but you're not only reliant on income potential to drive your total returns. So perhaps, again, if you believe markets go up over the very long run, you have potential for perhaps less NAV erosion that can occur with strategies that are just focused on income potential. So really a few different benefits here. We are, again, we think the idea of combining that high income potential with the weekly distribution solves sort of an interesting need there. And then having the market exposure then can potentially prevent against excess NAV erosion that can come from high income strategies.
Okay, so tell me a bit about the covered call strategy. That's always the first thing I want to hear from when there's a covered call strategy. Obviously, they have to be out of the money calls because you're capturing some upside. So is it a daily, are you writing like a 2 or 3% out of the money call every day? Is it a set in stone systematic approach, or what is the upside cap, or what is the actual covered call strategy?
Yeah, it's interesting. So when we were looking at this strategy, we were really debating, should it be a kind of a fixed number, to your point, 2%, 3%, 5%, maybe more. But what we learned, particularly when trading daily, and then when trading 0 DTE options, so this is really important because these funds are distinct, that we don't just trade daily, we're trading options that expire the same day. It's not prudent to go out and say we're going to target a particular number or a particular premium. And the reason being is that markets are dynamic. And particularly when you're trading something that is a new instrument, like zero days to expiry options, we need to be varying because we want to ensure that we're actually getting the best possible prices as well. So you're going to see, again, we've been fortunate that we've generated relatively high income to date. That's going to vary what the potential yield could be depending upon the market environment. Because again, we're not just going out and blindly targeting a particular level. What's interesting though is that we have even seen since really high income strategies using short dated options have come to bear. So let's call it for the last year or so, there's been a structural decline in volatility across the market. So we are, particularly if you look at the new 1-day VIX, we are in a very, very low volatility environment. So moving deeper out of the money can have the potential for generating significantly higher returns, or sorry, higher income potential because of the premium that's earned.
Okay, so but basically is it always going to be out of the money? Every day you want to capture some upside, is that the strategy? But the out of the moneyness is going to depend on market conditions.
Correct. There's going to be variability there depending upon market conditions and as these products mature, right? So I think it's important for investors to know, and what I love about engaging with folks like yourselves and your audience is that there's this income universe or cohort of investors wants knowledge. Oftentimes I work with folks who are just momentum seeking or just kind of looking at whatever has the highest return. Not the case here. So I want to be transparent and say, hey, as this universe develops, we are the first ETF to do covered call on true 0 DTE options. And as the funds have grown, we've already seen some interest and inflows. There's going to be some dynamicism there, which is important, particularly as we think about days like the Fed day we saw, where the potential for premiums was really high. And then when we move into earnings season as well. Again, even though these are index-based strategies, particularly the NASDAQ is going to be very dependent upon when those big Magnificent Seven stocks report in a couple of weeks.
Okay, so this is an actively managed strategy. This is not a systematic strategy, and your manager is going to decide the moneyness of the option basically on a daily basis, depending on market conditions. That's what I've summarized from.
Yeah, exactly. And we're not trying to go out there and say, hey, we want to, cap all the upside today. It's not a gunslinging type strategy, but yeah, it is dependent upon the market environment.
Okay, and income is the primary focus.
100%. That's the primary focus by the prospectus and what the intention of the strategy is.
Okay, 2 questions that I had on your website. So we'll talk about the weekly distributions in a second. So weekly distributions, high income potential, obviously. What does this mean here? Harness volatility, QDTE sells 0 DTE options on the NASDAQ 100. And this is what I wanted to ask you about. Seeks to exploit structural market mispricings. What does that mean exactly? And by the way, you have, I believe, the same thing on the XDTE, right? Same.
Yeah, that's correct. So the what we mean by structural market mispricings is that, and actually there's been some research by the CBOE, major investment banks like Goldman and JP Morgan all have commentary on this and different viewpoints. But zero DT options, or moving from a monthly option to a weekly option to a 1 day, or particularly zero, has sort of an emerging ecosystem. And primarily a lot of the investors who are not, we are selling the options, but those who are buying them, right? So this is not what our strategy does. We are selling it to people who do this. It's a lot of retail investors, and then I'd say very fast money hedge funds. So they are not as concerned about the price that they may be buying something for, but they're focused on quick moves, either hedging to the upside or gaining further exposure, maybe hedging in some way. Doesn't appear that way necessarily to us, at least now. But the reason why that's relevant is that, and why we have the sort of need for dynamicism and not just have a systematic set it and forget it strategy, is that there's inefficiencies that exist in any market that's new. Particularly one that has sort of a large pool of again, a lot of people talk about retail being dumb money. I hate hearing that. But anytime there's one group of investors, retail, financial advisors, institutions, who dominate a market, inefficiencies can happen. And right now, that's what we're seeing with the zero DT option space. And so the premium potential increases when volatility is higher, right? When we're in market environments that are driven sort of by retail sentiment. So important kind of consideration for us, that why we thought using zero DT options could add even more firepower to this strategy potentially.
Okay, all right, and yeah, expense ratio 95 basis points all in. This goes for the other one as well, the S&P 500. Really quick here, the holdings. Can you explain the holdings? So this is what the fund holds. Obviously, I'm assuming the one in the middle is going to be where you're putting cash into short-term treasuries, like many of these style ETFs. Then obviously you're going to have your Nasdaq 100 long exposure and the daily option. Do I have that right, or do I have that completely wrong?
Well, you're pretty close.
Okay.
But there's one distinction here that I'll note. But let me explain the holdings first. So there are two sort of synthetic Nasdaq positions on the portfolio. Most of it is in that first holding. Let's call it the ticker for NDX. That is the traditional Nasdaq 100. These are sort of exposure. The one below it, XND. That's called the micro. So they actually trade with a lower handle. So traders and investors use those for precision, and we're using those to round out the exposure again as these funds grow. And then you see the money market fund that has exposure to treasuries. What's missing is what you said is that trade, is that option. And why is it? Because it would have expired. Friday's expired on Friday. Today's are going to expire today. We show you that if you X out of this for a moment here, we will show you that for investors who are interested in seeing that intraday trades right there.
Okay. That's
where you're going to see exactly what happens. So it pops up in a CSV or an Excel file. That's where folks can see, hey, this is actually the option that was sold today. So because you're not going to see those show up in the holdings file.
Okay, interesting. Okay, so these are the ones you're selling here, obviously here, yeah.
Yes.
Okay, interesting. All right, so let's talk about. Thanks for answering that. So that's pretty much the composition of the fund, the strategy. The weekly distributions, I was extremely surprised and even excited seeing that, because that's very, very unique, and you actually. You have the whole calendar here, and they're basically paid out every Friday, I believe. And so far you have you declared 2 distributions for both of them, right? And here they are right here. So why the weekly distributions instead of monthly? Is there an advantage to this for the investor of any kind? Why did you guys decide to do that?
Well, we think the advantage here, particularly in strategies that are seeking high income, is that you have the
Mhm.
potential either for more frequent reinvestment, if that's your objective, or for more frequent sort of premiums earned, more frequent distributions that you, in theory, I guess you could do whatever you want with.
Yeah.
But we do know which is the benefit, of course. So the idea is that there's more opportunity for investors to make decisions about what they're doing with the income that's being earned. Now, there were existing ETFs that did this before that kind of pioneered the use of weekly. They did not necessarily generate particularly high income, so they actually closed. So to date, we are the only ETFs in the U.S. market that pay distributions weekly. Those distributions, absent a market holiday, are going to happen. The pay date generally on Fridays, and then the declaration date generally on Tuesdays. So tomorrow, for example, we'll be announcing the most recent, the third, I should say, in this example, distributions for XDTE and QDTE.
Yeah, I mean, there's already 8.1 million AUM in the Q1 and 5.5 in the S&P. It's probably more. This is probably a day or two old. So that's pretty for very, very new ETFs. I'm pretty sure they're going to stick around for a long time. So that's cool. And a final question about these ones here. I noticed that the QDTE2 distributions were very, very close. Let me just go down here. Okay, this is the XDTE here. So the first one was 20 cents, then it was 18.8 cents. In terms of QDTE, pretty similar in the 30s. Why the discrepancy? I mean, this is a pretty big drop. Is this because volatility dropped? Is this something we could expect, varying distributions? Because a lot of my investors are income investors. They are requiring a steady source of income. So you could just comment on that if you don't mind.
Yeah, no, happy to do so. So yeah, it's interesting. So if we look at the kind of the environment that we were in for the Nasdaq, the volatility
Yeah.
has been very, very consistent, so that the income earned week over week was very similar. The S&P 500 had some a little bit more variability, and so as I noted, one of the things that we are focused on is ensuring that we have the high income potential, but not necessarily overreaching for yield. So I expect that to be smoothed out a little bit over time. But again, we are not targeting a particular distribution level every week or what have you. So this generally will kind of smooth out over time as the funds begin to mature. But there will be some variability, probably more so with the S&P 500 than the Nasdaq, depending upon simply based on where we are in the market environment today.
Okay, and are you paying out all the premium earned to the investor?
Yes, the objective is to pay out the full premium earned
Okay, and you're not paying out more than the fund takes in. That's always a big concern of investors. You're not giving investors some of their money back. You're just paying out the premium earned, and then the other part of it, which is, if the S&P 500 goes up or the Nasdaq 100, you're going to capture that in the stock price.
Yeah, the objective is not to pay to overpay.
Okay.
Right. It is. Now, I cannot go out and guarantee, as you've talked to other fund managers, any particular distribution and the ratio of what that looks like. But there are strategies out there that will kind of dip into the capital in a different way, or the kind of pool of investments in a different way. That's not our objective. The objective of the fund, particularly as they grow, is to have that long exposure to the Nasdaq or S&P 500 respectfully, and then again on a daily basis, selling options that expire that day to generate the premium in the fund.
Okay, makes sense. I don't have any further questions on these two very, very interesting strategies. Well, I'll definitely keep an eye on them and we'll see what happens. Very, very interesting. Last but not least, of course, I got to talk about YBTC because this channel is about income investing. So this is a Bitcoin covered call strategy ETF. Same managed MER, by the way, just to my audience. And what it looks like you guys do is you're writing covered calls on the BITO ETF from ProShares, which is one of the most biggest liquid Bitcoin ETFs. Of course, now we have the spot ones from, you know, IBIT, from BlackRock, and the Fidelity, VanEck, Cathie Wood's one, et cetera, et cetera. So my first question on this one here is, what is the covered call strategy again? Because it does say you're getting upside exposure to Bitcoin subject to a monthly cap, which is basically all covered call strategies. What is that cap? Is this once again an actively managed strategy, or you're writing 10% out of the money every month and just rinsing and repeating?
So this fund is also actively managed, but there is a
Okay.
little bit more, I'd say, because it's not a weekly distribution. We have a little bit more systematized process, and it's not also trading options on a daily basis. So we are not going out and saying in perpetuity that it's going to be 5 or 10% out of the money. Generally, it's been about 5. The objective that we've had to date is around 5%. So there is but really the idea is the volatility of Bitcoin is so high,
Right.
and this is reflected through BITO or BITO, however you pronounce it.
Yeah.
The potential for distributions is incredibly high. So the distribution yield of this fund is close to about 90%. This number will vary. That was a big increase from the previous month, which was about 40. That reason being is that Bitcoin became much more volatile than it already was. So this will change a bit over time depending upon the environment, but in general, because Bitcoin is that much more volatile than equities, and equities are more volatile than treasuries, you know, we would expect this to have the potential for extremely high income.
Yeah, and you could see from the reason why the distribution yield is so high is because it's based on the last monthly distribution, which was absolutely enormous, $4.12 a share, and the last ones you see here, you know, about a quarter of that. So that, as you said, it's attributable to Bitcoin's recent volatility, and of course, we could expect variances based on volatility, like all covered call strategies. So, a couple of questions on this one. And the first thing I will say, and really good thing, and commend you on, is you guys actually have, because not all fund managers do this, you actually show the upside cap
Yes.
of every option. So this basically means that there is 14.37% more upside potential until your covered calls reach the strike price, right?
Correct.
Really, really cool. I really like that. So, I mean, 14%. These are really out of the money calls, I'm assuming, because right now there's lots of volatility. So you could write out of the money.
Yeah, exactly.
Awesome.
But thank you. Yeah, we thought it would be helpful so it's good to hear that you agree,
Very
for particularly
helpful. Very.
to see this, so folks need a sense of, hey, what am I giving up? Because
Yeah.
there are this fund's interesting. We've had some really I'd say engaging conversations with investors about it. There are many people coming into it. Again, the objective, it's covered call strategy, is income. Just thinking about it that way. But we're also hearing from folks saying, hey, I know I want to have exposure to Bitcoin, but I'm not comfortable with all of its volatility. This is actually a way to lower your volatility to Bitcoin and have the potential for really nice income too. So to me, I view this strategy just simply because of all the attention to Bitcoin, maybe a little bit differently than other covered call strategies. But either way, I think it's a really compelling opportunity for those seeking income.
You perfectly described the classic covered call strategy. Whenever you're adding covered calls to something, you are lowering your volatility, you are lowering
Yes.
your risk. It's kind of like the mantra that I've been saying on my channel. Uh, so thanks for that. Really appreciate it. And thanks for putting the option here with the days to expiry. That's just beautiful. Just tells you exactly what you guys are doing, which is awesome. Quick question. Why covered calls on BITO and not IBIT on the spot?
Well, what's fascinating is that there are some, as we know, and we follow that the U.S. Took a long time to get Bitcoin ETFs approved in the U.S., or spot Bitcoin ETFs, I should say. What's not yet approved is options on those ETFs. So
Okay.
even though IBIT and really a lot of the funds have grown really sharply, there's not yet options available. So we are using where they are available, and that's FIDO. However, if you were to go through our prospectus or other legal documents, you'll know we have, you'd find, I should say, flexibility to modify that over time.
Okay.
So our goal would be to always use where's the most liquid options market. Right now, really the only liquid one is FIDO, and so that's why we're there.
Makes 100% complete sense. I think I had, what other question that I have? Oh yeah, Ethereum, you're thinking about doing one on that too? I know you can't discuss future products, but...
Yeah, well, we're excited to have these in the market. I would say there's a lot more that we have potentially coming from us as we kind of make a name for ourselves. To your point, we're still a relatively new ETF issuer. We became most well known in kind of thematic equities, and now looking to do the same in the income space. So hopefully with more engagement and conversations with folks like yourselves and the audience here, as these funds grow, we can look to introduce other ones.
Okay. All right. Final question about this one, and then one more question about the QDTE and XDTE that I completely forgot. That's important. The only other income-oriented Bitcoin ETF that I personally know of, maybe there's another one I don't know, is MAXI from Simplify. But that one doesn't, that one that holds Bitcoin futures, so full upside or most of the upside to Bitcoin. And they just do short-dated call option spreads on random things to generate some income. So in the way I look at it is, this one you're kind of buying Bitcoin and you're getting more Bitcoin upside. If Bitcoin you're capturing more, probably you're going to get less yield. And this one you're capturing a bit less Bitcoin upside, but you're getting more yield. Is that an accurate way to describe the differences between these two ETFs? If not, how would you describe the difference between them two?
No, I think that's well said. At the highest level, you can, I'll basically repeat what you said. I think of YBTC as a means of generating the potential for extremely high income because of the volatility of Bitcoin with some upside exposure. Its peer is really mostly about the upside exposure paired with some income potential. So they're almost opposites in some way, even though income is a common thread, but income first in YBTC is kind of the simplest way I would think about it.
I always appreciate when the professionals confirm what I'm talking about. Because sometimes, I feel like I don't know what I'm talking about, but I guess I do. I guess I do, which is great. So thank you so much for that. Last question. I don't want to hold you up. You've been here. You've been more than generous with your time. Going back to QDTE and XDTE, it's quite obvious your competition is going to be QQQY and JEPY from Defiance. What differentiates your ETFs from theirs? It's very, very, very similar, except you actually have the official covered call. They do in the money puts, which is essentially kind of the same. The two major differences I see is weekly instead of monthly. Weekly distributions on you guys, monthly, and the management, the MER is just a tad less, 4 bips less. Is there any other major differences, or why would investors choose the Roundhill ones over the Defiance ones? Maybe I could ask it that way. Yeah,
so the weekly distribution certainly a big component, and we think is a strong selling point for our funds. There is, again, the nuance is that we are a daily covered call strategy, so we will have that overnight exposure to markets. I believe that theirs doesn't necessarily have that. So we have the beta profile over the long run will be different. In the shorter term, I really recommend investors know what you own. To your point, they function principally the same, at least option strategy wise, even if they're not, and really get a sense of what are you most interested in. And then as we begin to have a history and series of our dividends, start saying, hey, is there a dividend being paid and their NAV is staying the same or going up? And then compare that to others, and really then can make a decision for yourself. And like I said at the beginning, and you said, weekly distributions could have higher potential for either reinvesting or for using that cash in other purposes.
Do you think having weekly, let's say you buy both funds, you put them both on drip, do you think having it weekly will increase the compounding effect over time? You think that is definitely one of the benefits versus a monthly?
Certainly. That's definitely going to be I think would be a benefit over time. Of course, time will tell if that's the case. But I would, and again, it's going to be there's a lot of path dependency that can occur depending upon when you're starting something like that. Is it an up market with low volatility? Is it a down market with high volatility? A sideways market? But all of that, that would need to be considered. But all else being equal, more opportunities is in this case better than fewer.
Super excited to see how it goes. Total return is the ultimate truth teller. We'll see what happens after about 6 months, a year. I feel it takes you at least 6 months to at least a year to actually compare something and see how it goes. So we're very, very early, but listen, thanks so much for taking the time coming on. We'll definitely keep track of these ETFs. Hope you come back on the channel soon, and looking forward to more income-oriented products from Roundhill. So again, Dave, thanks again, and I'll see you next time.
Thanks for having me.